Hey, what's up guys, welcome back to the channel. In today's video, I'll be explaining the very basics of how option trading works, how to buy option contracts, and some tips on how to manage risk and be more profitable swing trading call options. This video has been a pretty highly requested one, and since the small cap penny stock market has been pretty slow lately, I think right now is a perfect time to make this video. But before we get into it guys, make sure to drop me a thumbs up and hit that red subscribe button if you haven't already. To start off, let's quickly understand the very basics of what an option contract is and what does it really mean. I know a lot of people tend to get confused as to, why do you buy call options? Why do you buy put options? But essentially what an option is, it gives you the option to buy or sell shares of a company. And in most cases, every single option contract controls 100 shares of the company. And the reason for why options exist is pretty simple. They're essentially a leveraged security. For example, if you have a margin account, you can borrow money from your broker to add more money to your account and increase your buying power, for which you can buy and trade stocks. And that's a very similar scenario here with options, where you're essentially leveraging your position or your bet on any single stock. So for example, if on a particular day, eBay moves up 3% on the candlestick chart, the option contract might actually move up 20 to 30 to 40% based on what your strike is and what your expiration date is. And also options are pretty useful for hedging your portfolio. If you're long a lot of stock and you're afraid that the market is overextended and we might see a crash or a correction in the very near future, you can buy long dated put options, which will give you the benefit when the market actually comes down, because they will actually make you more money. That'll essentially cover your risk for when your actual portfolio loses money. Just like anything in life or anything in the securities market, option contracts have some sort of value that you need to actually pay up for before you have that right to buy or sell the underlying stock at a specific price. And in this case, options have something called a premium, which is what you have to pay to actually buy one contract of this option. And it's this premium that we traders are playing the fluctuations of, because these premiums actually increase and decrease in value very, very fast based on what the underlying stock does. So for example, for the 17th September 2021 call option, we are buying this $80 call option right here that's trading at a price of around 40 cents per contract. I know this looks complicated, but the main things you want to focus on here are the mid price, which is this column, and the volume, which is this column. And just like you would trade regular stock or regular shares, you have a price that that contract is trading at, and you have a certain amount of volume that that contract traded for during the day. It's essentially like looking at a candlestick chart and seeing what the closing price for that day was, and looking at the volume for what that stock traded that day. And just like regular stock, you will also have a bid and ask spread. And this is one of the very important things to keep in mind with options, is you want to trade contracts that have a very tight spread. The spread is essentially the difference between the bid and the ask. And the tighter the spread, it means there's more liquidity and more volume, so that if you really want to get out immediately, you can get out with a very, very minimal loss. And you don't have to risk sitting on a limit order for too long. So for example, in this case, if we want to buy this 80 strike call option that expires on the 17th of September, we can click the ask and it'll show up the order here on Webull at the bottom. And just like regular stock, you can put in a limit order or you can put in a market order depending on how quickly you want to get into the position. Now obviously you might ask, if the contract is actually trading at 41 cents or 40 cents, why am I paying $41? Well, like I said, each contract in both the call and the put sides always controls 100 shares of the underlying stock. So if you want to actually buy one contract, you need to multiply the mid price or whatever price you get filled at times 100. And this is the leverage I'm talking about. You're basically able to control 100 shares of the underlying stock with less than 1/10 of the actual price upfront. And once you do get filled on this position, you can sell it immediately just like regular stock, but you cannot sell it during after hours or pre-market. I know for a lot of people that tends to be quite daunting, but you can actually forget about all the jargon that you see at the bottom here. Most of this is not important for us, because as traders, we are not going to be exercising any call or put options. We are not going to be waiting until the 17th of September to actually buy our 100 shares at whatever the strike price is. What we are doing is we are simply playing the price action and movement of the values of these contracts and selling them just like regular stock. And as you might know, most option contracts do expire worthless, and that's one of the reasons why it's best to stay away from exercising options. Another important question that a lot of newbies tend to ask is, how do you determine the strike price and the expiration date for your contract? And for me, the expiration date is actually very simple. If you are swinging call options, meaning you're holding them for a day or longer or even for multiple weeks, make sure that your contract expiration date is at least 45 days out from whenever you're buying the actual contract. And Webull actually displays this data very nicely. In this middle column, you can see the days to expiration from the current date for all these different expiration dates. So for me, if I'm looking to swing contracts overnight, I am buying anything over 45 days. So for me, I am buying a 15th October, a 19th November, or a 21st January call. And as for deciding between all four of these, it depends on your time frame. And the trade-off here is that the longer the expiration date, the more expensive the contracts are going to be generally. But as a rule of thumb, make sure you always buy contracts that are at least 45 days out if you're swinging calls. Now moving on to the strike price, this is also something that's very simple, but it's a little bit more personal and based on your risk tolerance. Essentially what the strike prices are is the price at which you would end up buying those 100 shares if you actually exercise the call and put option. But since as traders, we don't really care about the exercise price and exercising options, this in hindsight does not really matter. But unfortunately, it turns out that the premiums for the call options and the way they fluctuate actually depend quite a lot on where the strike price is. As you can see, the lower the strike price is compared to where the stock is trading at, the more expensive the premiums are, and generally speaking, they are the more safer plays. As you can see, eBay is trading around $73, and these are the strike prices that are well underneath that price, and these are the strike prices that are well over that current trading price. The ones in green, we call them in the money, and the ones that are in black are the ones we call out the money. And out the money options are typically more risky because they can expire worthless, because if you want to buy a 75 strike and the stock is trading at $74, well, you can't do that because the stock price is lower than your strike price. And that's why if you paid money to buy these 75 strikes and held them into expiration and you actually did not have the stock price above that strike price, then you're going to lose all your money. But again, as traders, that does not really matter to us, but that does make these out the money options always very, very volatile. And that's something you want to keep in mind, because even though the out the money call options are very cheap, they are more volatile. And if you are swinging something for a very, very long period of time and you're not very, very confident that the stock is actually going to move in a direction, then it's best to go with in the money options. But generally speaking, for newbies, I recommend going anything that's really very close to the stock price. So typically the 72.5 and the $70 strikes would be very, very nice for this case. And in cases where I'm day trading, I will often go for the very, very nearest expiration. So for example, in this case, I would go for the 20th August or the 27th August, and I would typically go very, very close out of the money. So in this case, I might go with the 73.5 strike or the 74 strike. But again, that's mainly for day trading momentum, and these are obviously very, very risky, so you have to be in and out of them very quickly. Now let's move on to some of the tips that I recommend for newbies that are looking to get into options for either day trading or swing trading purposes. The number one tip I do recommend is that always have a catalyst if you are looking to swing call options. That catalyst could be an earnings date, it could be a conference, or it could be some sort of merger that might be coming up in the very near future. Because at the end of the day, these catalysts are what bring in the volume, and they're the ones that can move the stock price in your favor. And with the options, unfortunately, you have to make sure that your stock price is moving very, very well in your favor, because even if the stock is moving sideways, your option will actually lose value. So in my opinion, it's important to actually trade stocks that have a lot of range to the upside and have a very clear uptrend. In this case, eBay, as you can see, has a very, very nice uptrend with a lot of support sitting around the 200-day and even the 50-day moving averages. And as you can see, the range of the bodies of the candles are very, very large on the up days, and the pullbacks are generally very, very strong. And this is exactly what kind of stock I would personally trade options on, because the volatility and volume is just going to provide me a much, much better risk to reward when I'm trading calls. eBay actually ended up reporting earnings a couple of weeks ago, and I decided to enter calls on this very big pullback we saw after the Amazon earnings came out. Whenever you see a stock that sells off because of another company's earnings report, and especially sells off very aggressively in a very strong uptrend, it's typically a good buying opportunity for calls, especially if the company is reporting earnings in the very near future. And that's exactly what was the case with eBay. I actually took an entry on eBay 17 September 75 calls on August 6th and ended up selling them for a very nice profit around August 11th, which was right before the earnings came out. And these are the kinds of plays that are really, really profitable. These 2 to 3 day swings that can provide a lot of liquidity and a lot of volume that can bring in more buyers and increase the implied volatility of the options. And implied volatility, for those who might not know, is actually one important factor that also determines the premiums of your contracts. And over 75% of the time, implied volatility actually tends to rise going into an earnings date. And when the implied volatility rises, that also brings up the price of your contracts. To demonstrate an example of why I always recommend you guys have a very strong trend and an uptrend on your chart whenever you are planning to swing options, especially into earnings, is ticker symbol ZNGA, which was a swing that I actually was considering taking a couple of weeks ago as a run up into earnings. And I believe I was looking to enter around the 27th of July. And as you can see, the stock did not perform very well, especially going into earnings. My thesis was that this was sitting at a 200 MA support zone, and we had a very nice risk to reward on the chart for a potential run up into earnings. And in addition, a lot of CNBC analysts actually saw a lot of good bullish flow going into these contracts. For those who might not know, bullish flow is essentially when you have whales and banks and institutional investors actually buying up a lot of option contracts, which could mean we could see a movement in the stock price in the very near future. But obviously nothing is 100% right, and in this case that flow was not right either. And as you can see, not only did the stock tank very, very badly right after earnings, but the stock tanked quite a bit and broke through the support zone right before earnings. In this case, Zynga was stuck in this very, very tight trend with no clear direction and a lot of wicks on both the upside and the downside. And we've seen a lot of uncertainty, generally speaking, with growth stocks over the past month anyways, and those reasons essentially combined together to provide a very, very poor option swing trade on this stock. But anyways, guys, that's all I have for you in this video. If you guys have any questions, leave them down in the comment section below, or feel free to direct message me on Discord. But anyways, guys, I hope you find some value from this video. I hope you guys have a good weekend, and I'll catch you guys in the next one. Take care.